This is an Uncover Japan Company research report on Yamaichi Electronics, ticker 6941. Yamaichi is a Japanese precision components maker whose semiconductor test sockets qualify chips and whose high-speed connectors move data around AI servers. The central question is whether its record fiscal 2026 profit marks a more durable earnings level or simply the high point of another semiconductor cycle. At the report reference date, Yamaichi traded at a forward PE of 17.2 times and price to book of 3.39 times. Fiscal 2026 return on equity was 21.1%, while net cash stood at 16.9 billion yen, and the equity ratio was 73.6%. The balance sheet is exceptionally strong, but 17 times earnings is also above Yamaichi's own normal year valuation range, so quality and cyclicality both matter. Yamaichi sells the high-reliability interfaces where electronic systems meet. A test or burn-in socket holds a chip against a tester during final inspection or high-temperature aging. Each new chip generation can require a new socket because devices become smaller, hotter, faster, and more densely pinned. The other large business makes high-speed connectors for communications gear, industrial equipment, and cars. These are not glamorous parts, but a failure at this physical interface can make an entire system unreliable. The segment mix makes the investment case easy to see. Test Solutions produced 26.4 billion yen of sales, half of the group, at a 26.5% operating margin. Connector Solutions produced 24.7 billion yen, or 47%, at a 17.8% margin. Together they make up 97% of sales and are exposed to semiconductors, AI, data centers, and communications infrastructure. That makes Yamaichi a focused way to access the theme, but gives it very little defensive ballast when the cycle turns. The 5-year financial record shows both operating strength and cycle risk. Revenue and profit fell sharply in fiscal 2024, when sales declined 22.5% and operating profit fell 68%. The rebound was striking. Fiscal 2026 revenue reached a record 52.7 billion yen, and operating profit a record 11.6 billion yen. This chart is why a single-point valuation can mislead. The same company that now earns exceptional margins lived through an earnings cliff only 2 years earlier. The fiscal 2026 recovery was more than a simple volume rebound. In Connector Solutions, operating profit rose from 1.21 billion yen to 4.4 billion yen, and the margin jumped from 12.1% to 17.8%, supported by AI data center demand for high-speed interconnect. Test Solutions remains the high-margin franchise, but whether this connector margin is structural or cyclical is arguably the most important forward variable. It is the difference between a higher earnings floor and a temporary peak. Cash conversion is strong in good years. Fiscal 2026 operating cash flow was 10.1 billion yen, and free cash flow was 6.6 billion yen. Yet the cycle is visible here as well. Free cash flow turned negative 1 billion yen in fiscal 2024. The reassuring counterweight is the balance sheet. Yamaichi has net cash, no material debt dependence, and roughly 74% equity funding. That gives management room to continue investing through a trough, rather than defend a stretched capital structure. The core moat is the test socket franchise. A socket is co-developed with a semiconductor customer early in a device program. Once adopted, it tends to remain in the test flow for that generation. Yamaichi also keeps the difficult upstream work in-house, including materials, precision tooling, and micromachining. That supports quality, lead time, and margin. The caveat is important. This is not permanent annuity revenue. Every new device generation creates an opportunity, but Yamaichi must keep winning the next design in. Yamaichi's return profile is unusually attractive for a component manufacturer. Return on equity reached 21.1% in fiscal 2026, while the equity ratio remained 73.6%. That combination suggests the return is being earned through operating performance rather than leverage. But the same chart prevents overconfidence. Return on equity fell to 5.4% during fiscal 2024. Investors should view the 21% figure as evidence of execution in a strong part of the cycle, not a guarantee of a permanently smooth return. Valuation has two credible interpretations. Relative to connector and socket peers, Yamaichi's 17.2 times forward earnings multiple sits below a peer median near 26 times, even though its 21.1% return on equity is among the strongest. Relative to its own history, however, the stock is above its normal year range of roughly 5.7 to 12 times earnings. The market is therefore already recognizing an AI-linked improvement. The key question is whether the earnings quality is durable enough to justify that re-rating. The report's author scenarios are illustrations, not price targets. The bear case combines a cyclical reversal with an 11 times exit multiple and reaches 4,297 yen by fiscal 2029. The base case reaches 9,202 yen using 575 yen of earnings per share and a 16 times multiple. The bull case reaches 15,542 yen if the AI supercycle persists and a premium valuation holds. The shape matters more than any single number. The base case is near the reference price, while the downside and upside tails are both wide. Yamaichi Electronics is a high-return, debt-free specialist in semiconductor test sockets and high-speed connectors. Its engineering moat and balance sheet are real, and fiscal 2026 showed how powerful the AI and data center demand cycle can be. The risks are equally concrete: a semiconductor down cycle, a reversion in connector margins, currency sensitivity, and a valuation already above the company's old normal. The next evidence points are test solutions demand, HBM and DRAM burn-in investment, connector margins, quarterly guidance revisions, and the yen. Please explore the full free deep dive at Uncovered Japan. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.